Good afternoon, guys. This is Chills and Day here with Chrono Historia, and today we're going to be talking about the top 3 best ways to easily hedge your stock portfolio. Just to summarize this entire article for you, what separates the wheat from chaff in professional investing is not your returns, it's your total risk in your portfolio. If you were to go to a client or even yourself and you were to say, hey, I can either get you 100% return per year with 100% risk, or I can get you 20% return per year with 2% risk. Statistics have shown the 20% return with 2% risk is a much, much better idea over the long term. And there's a couple ways to manage risk in a portfolio. Probably the best way, and it's like an art form, you should practice it, is learning to hedge your portfolio. And there's literally thousands of ways to do this, and there's always new methodologies coming out for it. But here's the top 3 best ways to easily hedge your stock portfolio. So this is strategies anyone can do, and if you get good at it, much like an art form or any sort of talent, you can actually get paid pretty handsomely to do this. Okay, so let's jump right into it. So the top 3 best ways to easily hedge a portfolio are the following. One, invest in inverse positions. This is going to be probably the most efficient way to do it, but it is hard. Not everything has a directly inverse position. These could be corporations that compete, inverse futures, stuff like that. Put option contracts. I'm assuming in this position you're going to be going long in a security or in a portfolio. You can find option contracts and thus, buy a put, which will, it's going to cut directly into your revenue per year, but it will secure your downside. And then the third one is invest in direct inverse ETFs. I do not recommend doing it because a lot of people don't understand that they rebalance themselves at the end of every day. You have to get it like on an intraday trade period. So, for example, in 1987, when the SPY crashed, I think it was like 20% due to algorithmic trading. Had you been in, I think it's SQQQ, it's the inverse of the US ETF, you would have, walked away with like 1,000% return. It's a high risk, high reward. Do not hold inverse direct ETFs for more than one day. Anyway, let's jump right into the first one. So we're going to find what a hedge is. A hedge is simply it stems from the root term is a hedge surrounded an estate in ancient England, or really 17th century England, and it was used to keep the riffraff out and protect the house from fires, animals, whatever. It protected your investment, which was your estate. So if you could think about your estate in this sense is going to be your portfolio, we need to surround it with a barrier, a wall, and this is the thing that's going to get damaged. This is called a hedge. So the first way to do this is invest in an inverse ETF. Now you call this pairs trade, or sorry, inverse position. This is going to be pairs trading to some degree, or really any competitor or position that will directly correlate when yours goes down. I talk about here the age-old one. You can do Coke, Pepsi, Pizza Hut, and Domino's. The theory is, like for example, if we're doing Pizza Hut and Domino's. If Pizza Hut goes up, Domino's will go down because they share the same product, the same consuming audience. And the inverse is true. If Domino's goes up, Pizza Hut will go down. This isn't necessarily true, and this is never perfect. But on larger macro senses, studies have shown it holds true. So probably the best way, as I say down here, the currency inverse hedge. A lot of hedge funds do this, and a lot of professional investors do this. It's probably the easiest one to do it. So if you're not aware, the U.S. dollar in I think 1974 was taken off the gold standard, right? Pre-1974, the U.S. dollar was worth a certain percentage of gold, and when gold rise, the U.S. dollar would rise. That's why we have, Fort Knox with a huge reservoir of gold. It protected against inflation. Well, with the U.S. economy exploding, we weren't going to keep it on gold anymore, so we took the dollar off of gold. The gold standard is what it's called, and as such, we based on more of a complex credit debit spread that allowed our economy to truly explode. It was a good idea. Now, what this means for you is any investment within the U.S. sphere of influence, within the U.S. economy, is going to be based off the dollar standard. If the dollar declines in value, like for example, SPY will decline in value, or the triple Qs will decline in value, in sort of inflationary aspect, or even just let's say the U.S. goes to war or something like that, the SPY will decrease, or maybe it'll increase. Who knows? But whatever happens, since gold is the inverse, since all other currencies of the world, well, majority of them are based off this gold standard. If the U.S. dollar goes down, their currencies will rise. Thus, gold will rise. This is called the currency inverse hedge, and it's one of the most popular and easier ones to do. A lot of portfolios run a 5% hedge, and in some of mine, I run a 5% gold hedge. The one I recommend is GLD. This is the gold miners ETF. Um, it's pretty much just a giant, basket of gold. And what's here on the screen, we can actually, this is pretty cool, but we can actually see a difference. So during the pandemic, so right in the beginning of 2020, we can see gold reached a peak. You see $1.9445 right there, $194. But at the same time on the SPY, we're at a trough, right? There's a direct correlation inverse hedge. So if we scroll back up to here, as you see, investment one will be this blue line, which will be the SPY. Investment two is the hedge, which is your gold. As investment one, which will be the SPY, declines, gold will increase. And the goal here is, if we go back to the overarching thesis of a hedge, is as your estate declines in value, your hedge is protecting it. So you're still in the game. That's the whole point of hedge funds. They kept business owners and people, affluent people, in the stock market, regardless of what was happening. And nowadays, you can do it yourself. So the first one is currency inverse hedge. This just goes over essentially no hedge is perfect. That's the problem. Hedging is an art form, and a perfect hedge you'll never find, right? What I mean by perfect is it's a direct one-to-one correlation. If gold goes down, SPY goes up. It never works out like that. There's too many variables impacting it. The better and better you get at it, the more and more perfect you can get, but it still will never be perfect. So then the second option, and this is for ones where you can't find a direct correlation, a direct inverse correlation, is to buy just a put contract. Yes. So for example, if a put contract costs $2,500, you are going to be sacrificing $2,500, right? But it will secure your downside. So if I buy, let's say the stock's worth $100, and I buy a put contract for 95 for 5K or something like that, I'm automatically throwing 5K out the window. But what I'm saying is, if that stock ever crashed, and let's say it went down like $20 a share, some cataclysmic event, well, I already have a buyer secured, which is the point of a put, at $95. So the worst I can lose would be $5 per share. And that's the power of kind of, these inverse, put contracts. So I can have a graph here that demonstrates that. So as stated here, here's $100 and $90 is the put strike. So I went ahead and bought it for X amount of money, just throw that out the window. But then luckily I did it because in this theoretical portfolio, as the year progressed and the blue line started downtrending, aka the stock's price started downtrending, I'm not selling at the end of the put contract. I'm not selling it for $45 a share. I already have a buyer secured at 90. So regardless, my stock can never be worth less than $90. So long as I have enough put contracts to balance it out. Typically, an option contract reserves the right to buy or sell 100 shares. So if I have 200 shares, I got to buy, two contracts or sell two contracts, depending on how you want to run. That's more of an advanced concept. We can talk about theta decay later. So then the easy hedge number 3, invest in a direct inverse ETF. Now, it is, when I say invest, it is more like wait and day trade these bad boys, because if you're not careful, when the inverse ETF rebalances itself, it's pretty much it shorts a company, and you can't just have a perpetual short because you're paying out a loan. Without getting into the semantics and the nitty gritty of it, every single day you hold a position in an inverse ETF, you have less money, less capital in that position. It will decay over time. So you don't hold it for a long time. You just wait for the SPY to crash or the US market to crash or whatever your ETF is to crash, and you just buy it during that day and you sell it at the end of the day or the next day. But don't hold it for multiple days. It's a bad idea. I don't think many people in the market will come up with any sort of strategy to tell you, hey, you should be holding a direct inverse ETF for multiple days. These things are pretty cool. Yeah, I don't know why this isn't loading, but yeah, SQQQ is a direct inverse of the U.S. market. So you can hold SPY, and then occasionally during massive downtrends, like let's say the current administration decides that they want to, I don't know, like not do bond tapering and just let the U.S. market crash. Well, maybe it's a good idea to sell the SPY directly and then inverse all that money, or buy the SQQ, and at the end of the day sell it. You might make like 30-40%. So as we can see, here's SQQ, a chart of it. During the 2020 pandemic, so we had one of the starkest declines over a couple months. You can see this. It went from 70 bucks up to 140. This is an ETF that in like a month doubled in value. Try to find many ETFs that can do that. But as you see over time, if you invested here in 2019, in January 2019, and it would be essentially worthless, So you don't hold these things for long. You just don't do that. So yeah, the conclusions are those are the top three easy ways to easily invest your hedge fund portfolio. It takes some time to learn how to hedge properly, and I'm always here. Just come on over to Chrono History, and we can always help you out with that. But you got to be careful with hedging because your hedge is theoretically what you're willing to sacrifice to protect your portfolio. That's what you need to remember. If you invest a $10,000 hedge, you're just saying, hey, I'm throwing $10,000 out the window, right? Just to cover myself. You can do a hedge with $2,000, $1,000. The better and better you get at hedging, the less and less capital you need to put up to secure, uh, a set percentage of capital. So, for example, on a $100,000 portfolio, typically a hedge would be $5,000, right? And that's just assuming the portfolio is actively managed. If you just want to passively manage it, portfolio, you might go up to like $10,000, $15,000. You never know. It depends on how much you can expect to return per year. Um, and that's essentially it. So, anyways, this is Chills and Day with Chrono Historia, and until we meet again, best of luck in your investing journey, and Chills and Day out.